In the late 1980s, the Imperial Palace grounds in Tokyo were famously valued at more than all the real estate in the entire state of California combined. At the time, Japan was not just an economic powerhouse, it was an existential threat to American industrial hegemony. Japanese corporations were buying up iconic landmarks like Rockefeller Center. The Nikkei 225 index was relentless in its climb toward 40,000 points, and the world looked to Tokyo as the blueprint for the future of capitalism. But then, almost overnight, the music stopped. What followed was not a typical recession that lasts a year or two, but a grinding, soul-crushing stagnation that has persisted for over 30 years. Today, the Japanese economy serves as the world's most significant cautionary tale. It is a story of how the most advanced nation on Earth became a laboratory for experimental monetary policy, trapped in a cycle of deflation and debt that no other country has yet figured out how to avoid. Stay until the end to find out why the lessons of Japan's lost decades are now the single most important warning for the United States, Europe, and China as they face their own demographic and debt-related crossroads. To understand how Japan fell, we have to look back at the incredible heights of the post-war miracle. By the 1980s, Japan had transitioned from a war-torn nation to the second-largest economy in the world. This growth was fueled by a unique partnership between the government, the Bank of Japan, and massive industrial conglomerates known as keiretsu. This system prioritized long-term market share over short-term profits and guaranteed lifetime employment for millions of workers. However, the success created a massive trade surplus with the West, leading to the 1985 Plaza Accord. This agreement forced the Japanese yen to appreciate against the dollar, making Japanese exports more expensive. To compensate for the stronger yen and keep the economy humming, the Bank of Japan slashed interest rates. This flood of cheap credit didn't go into industrial innovation. Instead, it poured into the stock market and real estate. By 1989, the Nikkei index had tripled in just 5 years, and land prices in major cities reached levels that defied all mathematical logic. Banks were lending money based on collateral that was itself inflated by the bubble, creating a feedback loop of phantom wealth that felt like it would never end. The collapse began in 1990 when the Bank of Japan, fearing runaway inflation, finally raised interest rates. The impact was immediate and devastating. The stock market bubble burst first, with the Nikkei shedding nearly half its value in a matter of months. Real estate followed shortly after, beginning a long-term decline that would eventually see property values in Tokyo drop by more than 70% from their peak. Unlike the 1929 crash in the United States, Japan's crisis did not result in a sharp, sudden depression followed by a recovery. Instead, it triggered a slow-motion banking crisis. Because Japanese banks held massive amounts of corporate stock and real estate as collateral, their balance sheets were instantly destroyed. Rather than forcing these banks to recognize their losses and shut down insolvent companies, the Japanese government and the central bank chose a path of forbearance. They allowed banks to keep bad loans on their books, giving birth to the phenomenon of zombie companies. These were businesses that were effectively bankrupt but were kept alive by constant infusions of cheap credit from banks that couldn't afford to let them fail. This decision effectively froze the Japanese economy in time, preventing the creative destruction necessary for new industries to emerge. The core of the Japanese problem is a phenomenon known as a balance sheet recession. When asset prices collapsed, millions of Japanese households and corporations found themselves underwater, meaning their debts were worth far more than the assets they held. Even though interest rates were dropped to zero, nobody wanted to borrow money. Instead, every spare yen was used to pay down debt. When an entire nation stops spending and starts saving simultaneously, demand evaporates. This led to a deflationary spiral where prices began to fall year after year. While lower prices might sound good for consumers, they are poisonous for a modern economy. If you believe a car or a television will be cheaper next year, you delay your purchase. If everyone delays their purchases, companies can't sell products, wages stagnate, and the debt burden becomes even heavier in real terms. By 1999, the Bank of Japan became the first major central bank in history to implement a zero interest rate policy. When that wasn't enough, they pioneered quantitative easing, effectively printing money to buy government bonds and even private stocks. They eventually moved into the realm of negative interest rates and yield curve control, attempting to force money into the economy by any means necessary. Despite these unprecedented efforts, the needle barely moved. One of the primary reasons is the demographic collapse that occurred alongside the economic crisis. Japan is the oldest society in the world, with a birth rate that has remained well below the replacement level for decades. An aging population creates a double whammy for the economy. A shrinking workforce reduces productive capacity, while a growing number of retirees increases the burden on the social safety net. As the working-age population declined, the government attempted to fill the gap in demand by spending trillions of yen on massive infrastructure projects, many of which were dubbed roads to nowhere. This fiscal stimulus, combined with the central bank's bond-buying programs, caused Japan's national debt to skyrocket. Today, Japan's debt-to-GDP ratio stands at over 260%, the highest in the developed world. The Bank of Japan now owns more than 50% of the entire government bond market, creating a situation where the central bank is essentially funding the government's existence. This has trapped the country in a liquidity trap where no amount of monetary stimulus seems to generate the targeted 2% inflation. The outcome of these lost decades has been a total transformation of Japan's standing in the global order. In the early 1990s, Japanese tech giants like Sony, Panasonic, and Toshiba defined the frontier of innovation. Today, many of those names have been eclipsed by rivals from South Korea, Taiwan, and the United States. The rigid corporate culture that once provided stability became a liability in the fast-moving internet age. The lifetime employment model made it nearly impossible for companies to pivot or for talented young people to start new ventures. As a result, the average salary in Japan today is actually lower than it was in 1997 when adjusted for inflation. While the country remains wealthy, safe, and highly functional, it is an economy that has lost its dynamism. The yen has faced massive bouts of devaluation, making the country's relative purchasing power on the world stage much weaker than it was 30 years ago. The winners in this scenario have been the large multinational exporters who benefit from a weak currency, while the losers have been the youth and the savers who have seen zero returns on their bank deposits for a quarter of a century. The ultimate lesson from Japan is that once deflation and demographic decline take root, they are incredibly difficult to reverse through monetary policy alone. Central banks can lower interest rates to zero, but they cannot force a shrinking, aging population to spend money they don't have or take risks in an economy that feels stagnant. For investors, Japan proves that demographics are destiny and that the price of an asset is only as good as the demand behind it. For policymakers, the Japanese experience suggests that structural reforms, such as making it easier for companies to go bankrupt and encouraging more women and immigrants into the workforce, are far more important than just printing money. The global economy is now watching closely because countries like China, Germany, and Italy are beginning to see the same demographic trends and debt levels that Japan faced 30 years ago. We are all living in the shadow of the Japanese experiment, trying to ensure that their lost decades do not become a global reality. The bottom line is that a healthy economy requires the constant birth of new ideas and new people. Without them, even the most powerful nations can drift into a long, quiet decline. Let me know your thoughts on whether you think the United States or Europe is headed for its own version of a lost decade in the comments below. Japan was the first to face these challenges, but it certainly won't be the last. This video is for educational purposes only and should not be considered financial advice. Always do your own research and consult with a qualified financial advisor before making investment decisions.